Hey guys, so in today's video, I'm going to be teaching you exactly what a fair value gap is, how to identify them, and most importantly, how to utilize them within your day-to-day trading in order to get better quality trade setups. So this video is actually an excerpt from my full A to Z trading course. Now I'm giving it away to you guys for free because you guys have shown me a lot of support over the year. So I hope you enjoy this video, and if you do, then please don't forget to leave a like, comment, and subscribe. And if you want access to the full A to Z trading course, then I'll leave a link for this down in the description. Without further ado, let's identify exactly what a fair value gap is. In this episode, we're going to be talking all about fair value gaps. What is a fair value gap? How do you spot it? And most importantly, how do we utilize it in our day-to-day trading? Right, so first of all, what is a fair value gap? A fair value gap is also known as a price inefficiency, and it occurs when there is an indifference between buy orders and sell orders in the market. So in a way, it's a one-way stream. The market is one-sided, more significantly dominant than the other side. And the reason for this is because for every order, there must be a counter order to fulfill it. So for a short period of time, when the market is one-sided and an obvious dominance is displayed, this is when an imbalance will be presented. So an imbalance will always be visible to us as a lone candle, and that lone candle is a representation of the institutional transaction, which is one-sided due to the large order. So the market will always look to counterpair, and the area of imbalance will always be targeted for the purpose of the market being balanced. So this is what a fair value gap is. So next, let's talk about how to actually spot a fair value gap. So a fair value gap will always be shown in a 3-candle formation where the first candle's wick will not be close to the third candle's wick. So let's take a look at these examples that I've got for us right here. So in a bullish scenario, we have a expansion to the upside. Then we have a massive push out. And as we can see, this candle stopped right here. When this candle started forming, it pushed down, but it was only able to push down this far. And then from there, it pushed up, but the highest it was able to go was up to here. And then now we've got the third candle, and the third candle tried to push down, but it got to here. And then it tried to push up, and it got all the way to here. So if I remove this, then the gap that we have left in between this wick and this wick, which I will mark out for you like this. Now this right here is the inefficiency. This is the fair value gap, and this is where a large institutional order was executed in the market, making it so that there was only buying pressure inside of this candle and no selling was offered. So why does this occur? This occurs because an aggressive move forces the market to move quickly, which causes the market not to be offered on both sides fairly. And if we now take a look at the other example that I have drawn here, in a bearish scenario, it is exactly the same but reversed. So we have the initial push down, and then this is how far the market was able to push. Now from there, we have this massive expansion to the downside with no wicks in this example. And once this candle closed, we tried to get a little bullish push up where we failed, and then a massive push to the downside, giving us this candle right here. Now, if we take our drawing tool right there and we mark out the difference from this wick to this wick right here, we can see that this entire area, there was only selling available and no buying was actually happening. Therefore, this is an inefficiency. This is an area where there wasn't a balanced amount of buys and sells. There was only selling available. Therefore, because these areas have large institutional orders, price is now going to be magnetized to this area. So because we know price is going to be magnetized to this area, we know that price will want to come back to even out the playing field, to put some buying pressure back in so that way we don't have this inefficiency anymore. And when price does come back, the one thing that we have to remember is price can either close at 25%, 50%, or even an entire 100% of the way. It doesn't have to do either or. It doesn't have to come in to balance it straight away. Price can rally away for a period of time before coming back to balance this area. Or if price wants, it can return immediately, rebalance this area before continuing its move in the opposite direction. So that is a brief understanding of what a fair value gap is. But the next question that we have to answer is, how can we actually use this in our day-to-day trading? So for that, first of all, what we have to do is, instead of looking at these examples that are beautifully drawn right here, we have to go and actually identify these areas in the live market. So let's jump straight onto some live market examples. The way the academy is structured, anyone who is willing to put the work in, there's just no way that they won't succeed. You have over 10 hours of content, a community of like-minded traders, my daily trade setups, weekly outlooks, a full support system so that you can ask me a question and I will answer it anytime, anywhere. And did I forget to mention, you get all of this for lifetime. Yes. Lifetime. There's literally nobody out there that is offering so much value for such a low cost. Not even close. So if you're actually determined to take control and change your life, then all you have to do is scroll down below, join the academy, and I'll see you on the inside. Right guys, so if we take a look at this bit of price action right here, what we can start to do is we can start to identify where the fair value gap is. So as we can see, we've got the first candle right here, the second candle right here, and the third candle right here. So the first candle wick is there, the second candle pushed up to here, but it wasn't able to go all the way. And then we had this massive expansion out, but it did try to come back, but the wick only came to this area. Therefore, if we mark out from wick to wick, we can see that this area right here, there was a lot of bullish pressure. There was a lot of buying happening. However, not that many sells were offered. Therefore, we left this inefficiency, this fair value gap right here. So now we know that this is an area where price can retrace back to, because it will be magnetized as price wants to come and fill this area in so that it can rebalance the markets. Therefore, we know when price does come back to this area, we then can start looking for some sort of buying opportunity in order for price to go the opposite way, right? So if we now play price on, let's go and actually see what happened. Price starts to come back, and what does it do? It fills it in 25%, 50%, and a exact 100% of the way before expanding out beautifully. So as we can see from this example right here, not only did price fill it 100% of the way and it rebalanced the market, but immediately after rebalancing the market, it expanded away beautifully. So that was a beautiful example of a bullish fair value gap. Now let's jump into a bearish fair value gap. Right guys, so if we take a look at this piece of price action right here, we can now start to identify this as our first candle, our second candle, and our third candle. So the first candle pushed down and it was able to get to here. The second candle tried to push up, but then we had this expansion out. And then the third candle tried to push up, but failed and only got this far up before stopping. So now we know that in this area right here, we had a lot of selling pressure, but not much buying pressure. Therefore, this created a fair value gap, an inefficiency where there was only selling offered and no buying was offered. Therefore, we know that this area is going to be somewhere that price is magnetized to, because price wants to rebalance the market, right? So we know that when price does come back to this area, we can then start looking for selling opportunities. So if we play price on, let's see what happens. Price, remember that price doesn't have to fill it completely. It doesn't have to fill it 50%. It can fill it 25%. It can tap it and run away, or it can even go above it. It doesn't just have to stop there, right? But in this example, what actually happens is bang, price completely fills the fair value gap, goes above it just a little bit right there, as we can see, and then it continues the opposite direction. So if you were to look for selling opportunities in this area, you would have been able to take a couple sells, which you could have wrote down beautifully. So that is an example of a bearish fair value gap. And I know you guys are itching for the answer to the question, which is, how do we actually utilize this in our day-to-day trading? Because if you guys are looking at the charts, I'm sure you can see that there are fair value gaps all over the place, right? We've got a fair value gap right here from this candle to this candle. We've got this massive fair value gap, which then price comes into, rebalances, and pushes away. So if you can see from the charts, there are fair value gaps everywhere. But don't worry, as we progress further and further into this course, what we're going to do is we're going to be starting to put everything together. Once we understand order blocks, fair value gaps, liquidities, lower time frame entries, we can then start piecing all of it together like a puzzle, so that way we can start generating these high quality trades. But for now, what I want you guys to do is to jump onto your charts and go and see every single area that you can see a fair value gap in. I want you to make at least 5 examples of fair value gaps that have been rebalanced, and once you take those 5 examples, I want you to document them and continuously go over them to actually understand how to perfectly spot a fair value gap. So that's going to wrap it up for lesson number 4, which has been all about fair value gaps. And I will see you guys in the next episode.